Stocks get off to a soft start but are off the day's low even as several global uncertainties linger. Autos and healthcare drag while consumer durables and IT eke out some gains.
Indigo says it flew its 2050 flights to all its 138 destinations, barring 2 due to technical issues on December 12th. The airline adds that its on-time performance has normalized per its standards. The stock sees some gain.
Rupee is down to a fresh low of 90.73 per dollar, down 0.35% from its Friday close. The fall is triggered by continued selling of equities and bonds by foreign investors, dealers say. India's November trade data due today, and dealers fear that if the deficit is as large as October's $41 billion, then Rupee may fall further.
The Cabinet has cleared the Insurance Amendment Bill that will now be introduced in Parliament, but CNBC-TV18 learns key clauses of composite licenses and open architecture may have been skipped to allow greater deliberation. Hello and welcome to Halftime Report live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra and with me is Sonal Bhutra. Well, it is turning out to be a session where we are seeing some amount of recovery from the day's low for the market, but nonetheless, it seems to still be a little tentative at this point in time. So we have the Nifty, which is just about lower by around 34 odd points. We have the Bank Nifty, which is just about recovered into the green as well. But what really stands out is the Rupee weakness, which continues. So it's another record low that the Rupee has hit in today's trading session. So that seems to be a bit disconcerting at this point in time. The advance decline ratio, a little bit on the positive side. So let's see how that sustains. As of now, around 2,100 stocks advancing to around 2,000 stocks declining. We do have the WPI data for the month of November, which is flashing on your screen. It is a deflation which has taken place, but it is much lesser in terms of the extent of deflation as compared to what we saw in the month of October, which was around 1.2%. We'll get Aditi Nair talking about that, but before that, Sonal, hi.
Hey, a lot of cues that we are tracking falling. Rupee, it is the WPI data that we are tracking as well. What's happening in the markets, of course, we'll discuss that in greater detail. The recovery is something we'll be tracking very closely because the Nifty is above the 26,000 mark. Let's get in Aditi Nair, who's the chief economist at ICRA, to talk about the WPI data that just came by. It's a deflation again, but of course, it's lower than what we saw in the month gone by. Aditi, is it in line with what you were expecting? And where do you think, what would the breakup look like for this one? What is the analysis suggesting?
Thank you so much. So basically, we were expecting a deflation of around 0.6% or so. So this is a little bit narrower than that. And I suspect that we may be very close to a break even by next month and then going into a small YY inflation in Q4. Broadly, if we look at the cues, we've had the rupee depreciation being one of the factors that the landed prices of commodities would be on the higher side. And even, the commodity prices themselves have gone up in some cases. Crude, of course, has eased over the last couple of months, but other industrial commodities have seen a slight hardening. So I think these are some of the cues. And then, of course, food inflation is a smaller component of the WPI than it is of the CPI, but we have seen some hardening in vegetable prices as well. And that is something that we would track for the month of December.
Okay. Aditi, what is your sense in terms of how the RBI is going to read these inflation numbers as well, considering that it is in the context of a depreciating rupee?
So, a couple of different things, Ekta. First, of course, this is not the last print before the next RBI policy review. We will get one more set of data for December in January, both for the CPI and the WPI. So I think the trend continuing between October and December, that is something that the RBI will be watchful of. And in terms of the rupee, when the rupee weakens, it has a quicker and a larger transmission to the WPI than it typically does to the CPI. So I think that's something that the RBI and the MPC would keep in mind as well. The CPI has a much larger weight of food. and also of services. And both these tend to be more domestically determined and have much less of a component of transmission of the rupee weakness that comes in. So I think, this context needs to be kept in mind as we look at what the MPC may do in the February policy as well. And of course, just to add, there is also some element of base effects which is at play over here. And as the base effects normalize, we do expect both the CPI and the WPI to be inching upwards.
Okay, so over the next 3 to 6 months, you expect WPI to inch higher. What are some of the risks you are factoring in when you're coming to that number?
So as I said, we would expect now the WPI to be close to a break even for the month of December, and then go into the positive territory in Q1. Earlier, we were looking at an like sort of average WPI inflation of around 1% in Q4. And now, depending on how the rupee evolves, the trajectory that we see over the next few weeks, we will take a call on how the impact on the WPI would be. So that is broadly what we're looking at right now. Break even by next month, average of 1%, but a trend upward basically in Q4. And an average for FY26, which would be around 0.2% or so. Main things to look out for would be the commodity price movement, metals and crude oil, the rupee depreciation, and the impact of whether we have an sustenance of the uptrend in vegetable prices or the seasonal downtrend that we normally see in the winter months. Does that kick in soon as far as the food inflation is concerned?
Okay, we also have the trade deficit data, which is due today for the month of November. Aditi, what is your expectation considering that October was quite a fearful number?
Look, I'm hoping that we're going to get a much better number, somewhere around $30 billion. Couple of reasons for that. October was an aberration for two reasons. One, we had the gold imports, which really surged during the festive season. So I'm really hoping that that is going to sort of normalize after October. The second, we had the festive season holidays in October. And what happens is that in the festive season, the import demand tends to be high, but the export shipments tend to be on the lower side because factories are actually shut for the holidays. So it does tend to be whichever month Diwali falls in tends to be like one of the worst months in the entire year for the trade deficit. And especially when we get this kind of a blowout on gold imports, I think, it was inevitable that we were going to get a number that was so bad. So I'm really hoping that November we will have the reverse coming in. Gold imports will normalize, other imports will also normalize. And with the base effect of a higher number of working days for factories, exports will look a lot better than they did in the month of October. So I'm hoping that the trade deficit will print in the vicinity of $30 billion for this month.
Sure.
Okay.
All right, Aditi, we're going to leave it on that note. Thanks very much for joining in and taking us through that. So, Sonal, that's going to be something that the street will be watching because it was a $41 billion record deficit that we had hit in the month of October. And we had the gold imports, which had surged nearly 200%. So let's see whether or not, that comes through in terms of a decline.
Okay, all right. So we'll watch out for that big number. But for now, we'll slip into a short break. When we come back, we'll connect with the big listing of the day, management of Corona Remedies, on the other side.
Welcome back. Well, let's talk about one particular company which has seen a strong listing. Branded pharma formulation major Corona Remedies has listed at an over 35 or maybe even 38% premium at this point in time. Do note that their women's health segment is a key focus. It's around 28.8% of sales. To discuss this and more on their second half outlook, we have with us Nirav Mehta, who's the promoter, MD and CEO at Corona Remedies, joining in. Mr. Mehta, thank you very much for taking the time out and congratulations. It's been a good listing for the company. But let's get talking on the numbers now, considering that you closed FY25 with an 18% growth and margins of around 20 to 21%. Just give us a sense in terms of what FY26 is going to look like on a closing basis for the company, both in terms of revenue growth as well as margins?
So first of all, thank you so much for inviting me over here. Let me first welcome the new shareholders in the family of Corona Remedies Limited. And we at Corona Remedies, since last few years, we have been growing in terms of revenue and the profitability in both the ways with our four, core therapies: women's healthcare, cardiometabolic, urology, and pain management will continue to do so. We are in line with our performance in terms of revenue and growth.
Okay, so you'll continue this growth rate going forward as well, what you've seen in earlier years. Mr. Mehta, then let's split it up. Your domestic growth has come in at 16.7% CAGR versus an industry growth that we've seen at 9.2%. Will this growth rate continue for the domestic business as well? Which are the segments which are leading to growth, and what is the outlook for this particular segment?
Yeah, so if you look at this women's healthcare, cardiometabolic, urology and pain management, this sector are already been growing little better than the pharma industry, IPM. It's been little better than the IPM. And we are in that sector. We have been growing mostly been double than the IPM, because our base is today has been low we have about 1.9% market share, in this industry, and long way to go. So we are, very, very optimistic and positive to grow with these therapies, and we will add new therapies also in this kitty.
Okay. Well, we do understand that, but we're trying to get down to, maybe some numbers, Mr. Mehta. Are you expecting to sustain this kind of outperformance in the domestic market? Are you expecting to sustain your margins at 20 to 21%, or do you expect further improvement? Give us a range in terms of what you're looking at and guiding for.
So, as far as our core therapies or core strategy is concerned, our aim is to grow a little better than the IPM. IPM is growing by, 8%. Our growth, aspiration is to grow by 1.5 to 2%, 2 times than the IPM. And as far as profitability is concerned, we have tried to, as revenue growth has been coming, somehow we have been getting the profit advantages, and that's been also continuing the same line as per the past year's performance.
Okay, so the target is to grow 2 times the industrial growth that these segments are witnessing, and generally
1.5 to 2 times.
1.5 to 2 times. That's the target that you have. You also said that you'll be adding some new therapies to the kitty as well. Will it be organically done, or will you be looking at some more acquisitions to add that to your portfolio?
Today it has been organic, so we are working with few other therapies like infertility, spine, rheumato, neuropsychiatry, dermatology, etc. We will try to unlock each therapies at the right time. To starting with, we are unlocking with the infertility in an organic manner. So, if you look at overall, we will grow about 1.5 times in the revenue, and similarly about 18-20% on the part of the PAT. EPS percentage growth will be in the line of 18 to 20%. That's our goal is.
Okay. Well, Mr. Mehta, I wanted to ask you, you have your cardio-diabetic segment as well, which is one of your key segments in the company.
Yeah,
How exactly are you looking at, this entire weight loss market, considering that we do have semaglutide, which is going to go off patent, and many companies are also tying up exclusively with the likes of Novo Nordisk as well as Eli Lilly in order to launch a second version of the existing drug. Any of these opportunities that you're looking to capitalize on?
Yeah, so we have been absolutely excited with this new, GLP-1 market. It is going to be big as far as India is concerned and as far as world is concerned. There is a molecule called semaglutide, which has been coming in the off patent in the end of March 26. And we are working for this molecule to launch since last 2 years. Our R&D team is working hard, and we are, optimistic to launch on the off-patent date as far as semaglutide is concerned with our mass division and class division. Okay. So we are very optimistic on semaglutide.
Okay, but are you not expecting a significant amount of competition on day one itself, and then that would just then be a volume game?
No, you're right, absolutely. But, if you look at the Indian pharma market, on our patent date, there are about 100 plus players have been launching the brands. And it's been quite normal. But as far as semaglutide is concerned, there are about 8-10 people will launch on a day one. So I think so there is a less competition as compared to the other patented molecule. And it is going to be a huge market as far as India is concerned, about 140 crore people. And, many obese and comorbid conditions. I think so this molecule has a wonderful role to play.
Okay.
So we are very optimistic.
The entire industry has been talking about it, so it'll be key to track how this market performs and what is the pricing game. And as Ekta pointed out, it could be a volume game as well. So we'll keep tracking those details. Mr. Mehta, thank you so much for joining in today with the insights on the business going forward and the other therapies as well. By the way, for the markets, there's been a further recovery. The Bank Nifty has surged from the lows, and the Nifty too is above that 26,000 mark. So we'll keep tracking that for you because it's just a little bit away from those green levels as well. We'll slip into a short break now. When we come back, we'll connect with Dheeraj Nim, who's the economist and FX strategist at ANZ Research, as Rupee is down to another fresh low today. Welcome back. Well, the other big story that we are tracking is Rupee going down to a fresh low of 90.73 per dollar. It's down around 0.35% from its Friday's close. To discuss more on the trajectory going ahead, we are now joined by Dheeraj Nim, economist and FX strategist at ANZ Research. Dheeraj, good afternoon. Thank you so much for joining in. Is there any fresh trigger that we are seeing a further fall in the Rupee and also on the trade data that we'll be getting today? Are dealers a little nervous ahead of that? If you can list out some of the reasons why we're seeing this continuous fall.
Well, thank you for having me on the show. Look, I think it's more of the same story. We have seen this trend of weakening in the rupee since there has been not much clarity on when the US trade deal would happen, which means that expectations with respect to the movements in the exchange rate have become rather one-sided. Now, what happens in such cases is that importers' hedging demand increases because everybody in the market is, so to speak, expecting the rupee to weaken, while at the same time, exporters remain at bay because they hope they will be able to realize a better price for their dollars later. So I think in such a situation, especially also when you have portfolio outflows continuing, we think that it is natural for the rupee to adjust. And the other contributory factor, of course, is that the Reserve Bank of India is not trying to give any particular direction to the USD INR exchange rate. In fact, they have been true to their word. They're just smoothing out the volatility. Now, coming to your second question about the trade deficit data, look, I think the trade deficit from a structural perspective has expanded. I mean, we expect it would be in the range of $30 to $35 billion. Of course, not as high as it was in the previous month, about $41.7 billion odd. There will be some correction to it for the underlying factors as festive demand would have lapsed and gold imports would have normalized a bit. But I don't think that particularly is triggering, the move in the rupee to a fresh record low. I think it's a part of the broader adjustment that we should see continue even in the months coming ahead till there is clarity on the US trade deal.
So, Dheeraj, in your sense, what is the level that you are looking at for the rupee in the near term where it could probably settle, and maybe a near-term range as well?
Right. So I think Q1 generally in any calendar year tends to be better for the rupee from a seasonality perspective. So we've pegged rupee at 90 for Q1 2026. Of course, the risk is that USD INR could be higher than 90, given the current momentum and the current levels. But we do expect some appreciation is likely because of seasonality effects. But by the end of next fiscal year, we had pegged the rupee at 91.5. I'm aware that, those levels could be realized much sooner than we currently project. But I think the rupee weakness has further to go is the broader theme from a medium-term point of view.
Okay, 91.5 in the near term. But Dheeraj, do you think there could be some level at which RBI steps in, they become uncomfortable? Or do you think flexibility is going to be the policy going ahead as well?
Look, at least in the near term, I think flexibility is the way forward. When most of the factors that guide the balance of payments and the currency, therefore, seem to be geared against the rupee, so to speak, I don't think the Reserve Bank of India should try to fight the tide. I mean, of course, the dollar has weakened somewhat since, the last couple of weeks. That gives some elbow room for the RBI to contain the slide of the rupee. But at the same time, we think that the recent intervention pattern of the RBI being a little hands-off than it had been before suggests that they are perhaps open to a weaker rupee. Look, I must highlight that, at this point, the rupee's levels do have welfare consequences. I mean, you're looking at very, very elevated tariffs impacting exports of some very employment-intensive low-tech sectors. So, I mean, a weaker rupee would at least support the earnings for those exporters. Still, we know what tariffs would be after a trade deal happens. So I think that that's important right now.
Okay, absolutely. That point is taken. Well, Dheeraj, we also have, the trade deficit data, which is due today. And that might be very critical in terms of assessing how exactly the trajectory of the rupee would be. If it's above $30 billion, the fear is that there could be further currency weakness. Are you looking at that data and what the impact could be in terms of the currency?
Yes, so two data points within the broader foreign trade data are worth noting. The first is, of course, the headline trade deficit. We expect it would be about $33 billion. Of course, in the last few months, the forecast errors have been large because of unexpected outcomes. But $30 to $35 billion, if you compare to India's trade deficit historically, is still very wide. So I think that by itself is a bit of a concerning aspect of the trade data. But within the export data, we would be watching out for what's happening to exports to the US. Now, within the last couple of months, I mean, the September and October data that we had seen an export recession of shipments to the US. Our fear is that that could deepen because in the first 2 months, when the 50% tariffs kicked in, exporters were still trying to retain market share, say by giving discounts or say by rerouting shipments somewhat, or some of those factors, which could have helped in the immediate term, but it would be difficult to sustain those measures over the longer term. So our fear is that, if the elevated tariffs stay in the picture, then the export recession, which is the shipments to the US I'm speaking about, could actually deepen. And if that is the case, the fear of the market with respect to tariffs affecting both cyclical and structural growth in India could very well, acquire a more definite shape, if not anything else. And I think that could itself be also a pressure point for the rupee.
Okay, Dheeraj, thank you so much for joining us today with your insights and the outlook on rupee. It was a pleasure speaking with you. So that's the word coming in from ANZ Research. They could see levels of 91.5 on the rupee in the next year. But with that, we'll do one thing. We'll slip into a short break. As we do that, here's some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
Welcome back. Well, for the markets, yes, there is a recovery which has taken place from the day's low. But one stock which stands out is Shakti Pumps. That stock is up another 11%. Remember that it's been in focus because of order wins that it has been receiving. It did receive an order just last week, which was worth over 400 odd crores. And then on Friday, it topped it up with a total value of around 2,000 pumps at around 71.25 crores, which is supposed to be executed in the next 120 odd days. So it is possibly the spate of order wins which is keeping the stock so active. As you can see, in the past 7 odd days, it's gained around 30 odd %. That stock up in double digits in today's trading session as well. But let's talk about another stock. Amber Enterprises is surging trade as the management has reiterated a strong guidance. Upasna is here with more details on that. Upasna.
Well, certainly. Company recently held its analyst meet, and the positive commentary is what we are seeing. And the company has also indicated a sequential improvement in its consumer durable segment. Now, coming to the key points first, the management has reiterated their guidance. They are implying a strong 13 to 15% outperformance to the industry in the consumer durable segment. For FY26 overall, Amber expects 10 to 15% Y&Y growth in RAC segment and 35 to 40% Y&Y growth in electronic segment. Now, coming to consumer durables, the the company has stated that the demand has improved sequentially, while there is still channel inventory in the system for RAC. Mind you, 1st Jan 2026 onwards, new energy norms kicking. So that's also an important point to keep in mind. Now, electronic division, the second most growth driver of the company. Company said that the growth in this will outperform the other segments led by new client addition and acquisitions. Now, company has also indicated industry-leading growth in its AC segment, and it also has given a strong growth outlook in the medium term for company's non-RAC segment. And most of the focus of the discussion was on the company's electronics segment. So overall, certainly a positive commentary coming in from Amber Enterprises.
Okay, all right, Upasna, thank you so much for joining us with all those details. So EMS companies, they've been in focus. Amber on our radar because of the management commentary that has come by. With that, we'll slip into another break. On the other side, Manisha Gupta will join in with Philip Newman, the MD of Metals Focus, in our commodity segment. Stay tuned for that. Welcome back. You're still tuned into Halftime Report. Precious metals continue to rise this year, with gold rising to a 7-week high recently, while silver holding steady around record high levels. Philip Newman, Managing Director at Metals Focus, tells my colleague Manisha Gupta that silver could hit $70 an ounce by next year. Let's listen into a piece of that conversation.
From our point of view, we are still bullish on silver for next year, even at these levels. We think that it could approach 70 next year. I realize maybe that doesn't look so far away from where we are today at about $62. But I think the important thing from our standpoint is that, given how quickly it has risen over the past few days, I don't think it'll be a straight line rally to that high that we see for next year. As you know, it's a pretty small market. A lot of volatility can happen. So we think that you could see, in the short term at least, perhaps a correction. But I think any correction could well also be quite short-lived as well.
Philip, how are you also looking at the buying part of it? Because now this year clearly has been about speculative buying, short squeeze even, and then industrial demand, everything played up, including the supply deficit. Is it going to be a similar story next year?
Well, I think, it's quite possible that we will see at times the market remain tight. We are looking at the dynamics, how that's playing out in London. We've seen the resumption of ETF demand that will contribute to that tightness. But as you know, the Indian market has backed off. We're in a small discount at the moment. So that isn't taking silver from London as it has been quite recently. So on the other side, that helps to ease the tightness. I think from an industrial standpoint, that's one we're keeping a very close eye on. Something like the photovoltaic market, which, as you know, is the single largest area of industrial demand. I think at these prices, that will be encouraging panel and module manufacturers to really perhaps ramp up the efforts to thrift on the use of silver. So I think that will still be a very good figure next year in terms of demand, but I think it could ease back from where we are at present.
Philip, also when it comes to the overall price volatility, that seems to have gone higher as well. As you mentioned that India markets have seen a bit of a discount, but India also seems to be looking at almost the same number as last year in sense of imports. So would you say a 6,000 tons perhaps is a given right now?
It's possible. I think it's just to see how the market reacts. As you know, the price today is about, I think, 193,000. But we saw, during Diwali, there was buying into 200,000. But I think, as we've now moved past that, it'll be interesting next year to see how consumers react to these prices. We know that Indian retail investors tend to be naturally quite bullish. So will they be buying into the rally? Or will there come a point where they think, silver's had an incredible run, successive highs, maybe it's time now to book profits. And I think if that happens, then that maybe will be a question mark over the imports that we've seen recently.
Let's talk about gold then, and Philip. And we've seen 4,200 kind of be a number where it's pivoting around, consolidating even for the last couple of months. What is it that you think is going to be the future trajectory for this?
Well, given what we said about silver, then part of that is, further strength in gold. And you're absolutely right, Manisha, in terms of the prices consolidating. We would take that as a very strong positive, that the market is very comfortable from at these levels. And again, even if we see a correction, we would think that will be short-lived, that will be bought into. And so we are positive for next year. We still think that gold could eclipse 5,000 before the end of 2026. Many of the factors that have driven prices this year will carry on into 26. And so, we're looking, a more dovish Fed after, of course, their cut yesterday. Question marks about Fed independence. And all that, of course, feeds into that moves about dollar negative, gold positive as well, plus diversification arguments. And there are a few other drivers out there. So I think we still feel quite comfortable with our forecast, as I said, beginning with a 5 for 2026.
Oh, well, yes. Philip, also when it comes to gold therein, the physical buying has been strong here too. Next year, apart from all the macros that you mentioned about, what do you see in sense of physical buying, whether it is about institutional, again, retail and the central banks?
Well, I mean, if we start with the central banks, the first 9 months of this year, the total was only about 13% lower against the first 9 months of last year. And last year was, close to a record high total. So I think for the full year, we could be looking at somewhere between, say, 800 or 850 tons. That is an exceptionally strong performance. And I think for 2026, we do think that central banks will still remain on the bid. So in terms of the price support that provides, the positive sentiment, I think that's certainly something we're looking for. I think for a driver, though, in terms of the upside of that 5,000 I mentioned, then you are looking for that continued institutional stroke hedge fund play to be there in the market.
Welcome back. You're still tuned into Halftime Report on CNBC-TV18. Well, it's turning out to be a session where we're seeing some amount of recovery from the day's low. But like we've mentioned, that the rupee continues to be weak. We have the Bank Nifty, which is just about holding its head above the water, so up around 55 odd points. The advanced decline ratio is looking a little tentative right now because when we started the show, it was on the advancing side. But now, as you can see, it's sort of on a parallel footing at this point in time, possibly going to crisscross soon enough. So as you can see, there is a little bit of a trending line which is closer to each other at this point. If you're looking at specific stocks from the frontline space, we have HUL, which is topping the list. So that stock is up around 1% at this point. Asian Paints from the FMCG space is not doing too badly as well. So that stock is up higher by around 0.5%. On the downside, it is autos which are taking a little bit of a hit today. So Eicher Motors, M&M, Bajaj Auto, all of these stocks are under pressure at this point in time. Even a couple of the metal stocks which had a good run last week are seeing some amount of pressure. So JSW Steel down around 0.7%. It's a wrap on Halftime Report, but stay tuned. Business Lunch up next with all of the top stories.